If you're new to options, covered calls might sound a bit intimidating, but I'm here to show you why they are a nice addition to your toolkit that can help you make profit on stocks you're holding for the long term that might be having a slow week or month. Really quick, I'm on to the next goal of reaching 1,000 subscribers, so please consider subscribing if you can. It's free, and it helps my channel grow and provide new content. Alright, so let's say you buy Apple at $105. After doing your due diligence, you think that Apple will have a slow week and you expect it to close around 106. If you hold the stock and it reaches 106, of course you'll make $1 profit per stock, but if Apple drops to 104 or 103, you'll have an unrealized loss on each stock that you hold. Now, what if you told someone, hey, I'll sell you a deal. You give me $100 and I'll sell Apple to you at $110 anytime from now until the end of the week. Does that sound like a crazy deal? Why would someone want to buy Apple at 110 when it's on the market for 105? Well, because they're betting Apple will be very bullish before the end of the week, maybe hitting 115, and then you'd be forced to sell it at 110. Let's plot out all the ways this trade could end up. Now, before I start, in order to sell a covered call, you need to have 100 shares of the stock. This could be as low as a $1,000 investment if you have a $10 stock, or $300,000 plus if you have a stock like Amazon. Scenario 1. Let's say you take the $100 and sell them the contract. Apple fluctuates and closes at 107 at the end of the week, so the contract that you sold is now worthless. Why would someone buy Apple from you at 110 when it's only worth 107? So you get to keep the $100 from the contract and you keep your stock. In addition, since Apple rose to 107, you could sell your shares and profit 200 if you wanted for a grand total of 300. Of course, you don't have to sell your shares. You could keep them and the 100 would be available in your account for trading while you still retain your stocks. Scenario 2. Let's say you were wrong and Apple dropped to 103. Again, the contract is worthless. No one wants to buy $110 apples when they're only worth 103. Now, instead of losing $200, you only really lose $100. This is because even though your stock loss is $200, your $100 profit from the call you sold helps reduce the loss. As long as it doesn't go over 110, you will keep your stock and the contract premium in full. The premium is basically the price they paid for the contract. Whenever your stock drops below the price you bought it at, the max you can make is the price of the covered call. So technically, Apple could drop to $100, which is a loss of $500, and the covered call would reduce it to $400 due to the $100 collected from selling the call. You also don't have to hold the contract till end of week. You can sell it early to claim profits or lessen overall loss from the stocks, but I'll cover that a bit later. Scenario 3. You were way off and Apple releases the iPhone 6000X and Apple skyrockets to 120. Now the person who bought the call is screaming, they're rejoicing. But what does that mean for you? Well, it's not all bad. You'd have to sell your 100 shares of Apple for 110, which means you'd still make $500 profit, and you keep your premium of 100 for a grand total of $600 profit. The issue is your gains are capped at $600. This is because no matter how high Apple goes, you have to sell it at 110. So in that week, even if it goes to $150, the max you can make is $600. Obviously, price spikes that high are rare unless there's a massive catalyst. I've actually been selling calls on Apple for the past couple of weeks, while Apple has been kind of bearish, and it's allowed me to make nice profit on a stock I intend to hold a few years. I would advise doing this on stocks that you believe over the long term will continue to rise. You don't have to hold these contracts you sell actually until the end of the week. You can buy back the exact contract because it's now worth a lower price to lock in your profit. Or if it's a higher price, you can also buy, but of course you'd be losing money. So I would advise when starting, you might want to take profits around 30 or 40% as you start and sell strike prices that are very high. I'll be showing how to do this on Robinhood because it's very popular for online trading. So go to your stock, hit trade, trade options, choose the week on the top, and make sure you put it to sell a call. As you can see, the closer the call is to the current price of the stock, the more expensive it is to buy, because it's very likely that this call will end up in the money. In the money means the strike price was passed by the current price of the stock. So for example, 116 is much more likely than 118 by the end of the week for Apple. So it's more expensive for buyers to buy the 116 contract. But if Apple closes below 116, even if it's at 115.99, you'd make the whole premium amount, which in this case would be $303. Not bad for a sideways moving stock. So once you find a strike price that you like, basically click it, open up one contract, This represents a 100 stock movement. Review and confirm. Remember, options trading happens from 9:30 a.m. Eastern Time till 4 p.m. Eastern Time, Monday through Friday. So you won't be able to do pre-market, after-market trading for these options, and definitely not on the weekend. Now to exit a position, click the option in your account. Go to trade, hit buy, and buy one contract. If you sold a contract for $100 and see plus 40, that means that the price of the contract is now worth $40 less than when you bought it. So to lock in profits, you could buy the contract for $60. You thus retain $40 total profit and no longer have a contract on your stocks. You're free to hold, sell, etc. like normal. One important thing to note, you know how options traders post losses of hundreds, if not thousands of dollars for holding options overnight? That's time decay, and it's also called theta. I have a video on intrinsic and extrinsic value if you're interested in that. But theta works for you when you sell options. So when you open an option and see negative 25 theta, for example, that means that the option's price will decay by $25 every day if it stays near the same price. You can see theta by clicking on the bid-ask price on Robinhood. Remember, with options, it's times 100, so you might see negative 24 cents, but that's really actually negative $24. I hope this gives you a basic understanding of what selling covered calls does. Thanks so much for watching. If you have any questions, let me know in the comments, and don't forget to subscribe. And as always, keep on making great trades.